So now we move on to the next chapter, or rather next section of our studies, which is the volume analysis. There are three chapters. I'm going to talk about them one by one. So if we talk about volume analysis, let's start first with the introduction to volume analysis. And what we have here in introduction is, before we start talking about the concepts, let's first talk about the key terms, key terminologies of the volume analysis. So let's talk about these terms one by one, and that should help us get the deeper understanding of what we are going to learn in the next chapters. Now, first of all, we talk about volume as a broad term, as a loose term, and for a layman or for a new person, volume is just the traded volume, or how many trades have happened, how many shares or individual securities have exchanged hands in given period of time. But there are different flavors, different types of volumes. So we'll look at each of those volumes one by one. We'll look at these definitions first, and that should help us understand what we are talking about and how there are different ways of looking at the volume as a concept. So first group volume definitions we start off with is market volume, total volume, tick volume, and related concepts, which is total assets. Now, what is market volume? It's also called as trading volume. So it's the number of shares or contracts or securities exchanged between buyers and sellers during a given period of time. For this particular section, we'll assume that time being a day, just for ease of understanding, but it could be any period of time. It could be an hour, it could be a minute, it could be a month. Right? So that is the total number of shares or contracts exchanged between buyers and sellers. That is market volume. Total volume or exchange volume. It's also called total volume, is also called as exchange volume. So it is the volume of all issues traded on the exchange. Now, market volume is about usually one particular security, one particular stock, or one particular commodity. For example, Amazon shares. The number of shares exchanged between buyers and sellers in a given period of day is market volume, but total shares exchange across all commodities, across all shares on a particular stock exchange, or particular exchange rather, not just the stock exchange, is called as a total volume. The total trades is how many trades happened. Now, volume is number of shares. Trades is how many shares, how many transactions happen. Obviously, when you purchase a share, not always, not everyone sells and purchases one single share. In most of the markets, the trade happens in multiple of one. In a lot of markets, we also have capacity to transact in partial shares, or zero point 0.1 of a share, 0.1, 10% of a share, and so on. So this is how many trades that happen to enable this total volume. So it could be 10 trades share having 100 volumes, 100 shares being exchanged. So total volume would be 100 and trades would be 10. Tick volume is the intraday sum of volume on a per transaction basis. Right? So it's basically intraday, and it varies from transaction to transaction. Right? How many transactions have happened in a particular day, intraday, during a specified number of ticks. In other words, if the share price of a particular stock has moved from $15 to $16, or $15 to $20 in a particular day, then the tick volume would be, let's say we pick a range between that particular movements, let's say $16 to $17. So tick volume would be how many shares exchange hands, how many transactions happened between that price range of $16 to $17. Right? So these are more general definitions. Next, we have open interest. Now, open interest is a very, very important and interesting concept, and oftentimes very confusing also. So we'll look at it in a greater detail during this part of the course. It will come in the future course of this series, but let's look at a definition of what is an open interest. Right? Open interest is the number of open futures and options contract. It's not how many transactions happened, it's about how many contracts are open. Now, you would know in shares, you buy a share and other person is or entity is selling the shares, the transaction happens and that's it. But in case of options or contracts, there are two parties, counterparties who are involved in the contract, and the transaction doesn't close, right? They are just entered into a contract. The transaction is about to finish, or second leg of the transaction is about to happen in the future period of time. For example, if I get into contract to buy 10 quintals or 10 tons of wheat at a future period of time, that's a futures contract. I am entering into contract just now, but the delivery is going to happen 3 months in the future. So between assuming that I stay in the contract till delivery, I have just opened one interest by entering into this contract, and that interest will be closed when the second leg of the transaction happens. The delivery takes place 3 months down the line when the contract is about to expire. Right? So that is an open interest. That's especially true in case of futures and options, which have a future delivery date or future commitment date, future transaction date for the second leg of transaction. So that is open interest. It's more like it's not a volume statistics, but it's more of a interest, market interest, and market dynamics measure. It's not a volume per se, but it's one of the important terminologies in our volume analysis. We'll look at it in the next course in greater detail, but for now we'll just keep in mind that open interest is the number of open futures and options contract, or any contract in which the delivery is set to happen, the second leg of transaction is yet to happen in the future, right? That's open interest. Next set of definitions we have is upside volume and downside volume. Now this volume is pretty self-explanatory. Now upside volume would be the volume that is traded on upticks. And in a day there is both upticks and downticks. Now shares or any commodity prices do not move in a linear fashion. They will be in a random walk fashion. So how many volumes, how many trades have happened on an uptick versus how many trades have happened on a downtick, that is called as upside volume and downside volume. Pretty straightforward. Next we have is dollar volume and capital weighted volume. Now what is dollar volume? It is self-explanatory. Again, the name could be helpful. The dollar volume is the value of the shares or securities traded during a given period of time. It's the value, it's not the number. So one stock of Amazon which trades around at around $300, and one stock of, let's say, GameStop, which is trading around $10-20, the dollar volume of Amazon, even though there's only one share being transacted, dollar volume of Amazon share would be much higher than GameStop volume. Similarly, we have capital weighted volume. Now this is especially true in case of index or exchange volume. Now it's not applicable for a single security, but more of an index or exchange traded volume, especially applicable in case of ETFs, which are basket of securities, right? Basket of shares. So this is the weighted average or capital weighted average of all the index components. There are 30 components, let's say, in Dow Jones Industrial Average. The weighted average, capital weighted average of how many transactions have happened in each of those 30 shares would give us the capital weighted volume. Next we have float. Float is the number of shares. It's usually associated with shares. How many shares of a corporation are owned by public and available for trading. This is also called as a free float or market float. So market float will tell you how many shares of a particular corporation are available in open markets to be traded. And why are these different than the all total number of shares that a corporation has, or the total number of stocks the corporate has issued? That is because some of the stocks, some of the shares are held by promoters, are held by employees, senior management, which are bound by certain covenants or contracts, or are not expected to be in public for trading. Promoters especially, they will not be willing to make their shares available for trading. They'll want to keep the shares with them for a long period of time, so they are not available for market for the common public to trade. And there will be also some types of shares, some percentage of shares which could be with a bank as a security for a loan that the corporation has taken as a form of personal guarantee. So these are shares issued or shares locked in with bank. So they are also removed from the total shares to arrive at the free float or market float or simply float of the shares of a particular company. And the last definition is average volume or a typical volume. So this is usually the average trading activity over a time. It's usually a moving average. So when over a period of time the transactions or volume is increasing in a particular stock, interest is getting generated, the average volume will go up. In case of very shallow markets or where there are no transactions, especially for stocks which are illiquid, penny stocks, the volume would be lower because the number of transactions that happen on an average day and a typical day is less. So average volume is or typical volume is how many transactions, how many happen or how many shares are exchanged on a typical day. It's usually calculated over a period of time and it's a moving average of volume being exchanged. Now let's talk about why is it important to include volume in your analysis and why price itself as a measure is not sufficient to get the full picture. It is often seen that, especially in case of liquid stocks, liquid securities, the volumes are accompanying parameter for a trend or for a particular pattern. When we see a huge drop or a huge spike in prices, it is often accompanied by more than unusual spike in volume. In case of illiquid securities, the volume is not very high, so you would see the prices being very erratic. Their transactions are very few, and as a result, the price discovery does not happen. So you may find a perfectly beautiful pattern, perfectly profitable pattern in case of illiquid securities, but that you cannot practically profit by entering into trade because there is no counterparty. You cannot close the trade. So in that case, the volume becomes very important for us to have price discovery as well as to have effective execution of the trade. So it's kind of complementary to the price data and the trends that we have. It acts as a magnitude. So the volume reveals the magnitude of a particular price movement. So we'll see some of the important concepts, important reasons why we should have volume as a part of our analysis. So first reason to include volume is that it validates price, and we'll not look at it from the share markets or securities markets, but let's look at the volume from the voting in elections perspective. Now you would know when a politician wins an election, it is important for them to win by a particular margin. A popularity vote determines how many people are still in favor of that particular politician. Similarly, when a particular transaction or uptrend happens in a particular stock, it has to be validated by price. Otherwise, it could be a temporary movement, a one-off activity, and it does not hold too much of weightage and should not be taken as a trading and profiting opportunity. Right? So the profit or the price is often validated by volume. Second is it liberates liquidity. As we had seen earlier, if you have to enter in a trade, there has to be a counterparty which is willing to take the opposite side. If you have sufficient volume, sufficient liquidity in the market, then only can you have this particular view. Then only can you have a particular transaction. Volume is an indicator that the markets have different views. There are traders with different ideologies and different expectations from the market, and that's the reason why we can profit from a particular trend. Even though all the market participants are seeing the same trend, let's say an uptrend, unless there is a volume, nobody can profit from the trend, because for any buyers there won't be any sellers, and for any sellers there won't be any buyers. So it would just drive the prices in one direction without being able to find the equilibrium. Other part is it substantiates information. Now, when the lockdown was announced in many countries, the prices plummeted very sharply and it was supported by a very substantial volume. A very large volume and a large number of trades happened which drove the prices down. The way to look at it is, if a particular movement, either upside or downside, has been supported by huge volume, then it is more likely that this particular information and the particular movement is a strong movement, is more sustainable movement. So the market overall has more conviction around it. So information is taken into accounted into the price discovery. But if in a particular trade or a particular slot, particular period, the swing in prices, either upside or downside, has not been supported by average volume even, or is a very thin volume, then it appears that it's not a very strong movement. It's not a very substantial movement. So a particular movement, to be substantial, has to be supported by a volume. If the volume in that particular direction is smaller or lower than the average, then it is very likely that this is not a real movement, or it could be a temporary move and the prices could reverse in the original direction. So it has to substantiate the information that is available in the market, and at the same time it has to reveal the conviction around those trades which have the market. Other part of the volume is it expresses interest and opinion. It goes hand in hand with the liquidity, right? Unless there are market participants willing to take opposite view of your trade, you cannot profit from the trade. You cannot exit the trade and you cannot make profits, right? If the prices have increased substantially and you want to sell the shares that you held long in your account, then you will not be able to realize the profit until and unless you can actually sell the shares, right? And to be able to sell the shares, there has to be somebody who's willing to buy the shares at that price. So if shares have spiked very high, in a very short period of time, if that price is seen as unsustainable, then obviously there won't be any buyer, and even though the unrealized profits in that particular open position is very high, you cannot realize the profits because you cannot close your position. So it has to have volume, has to have the information and interest of all the market participants who have opposing views, right? So that is one part. The other part is fuel and velocity for markets. That's also one of the reasons why you should look at the volume analysis. Now, what it believes, or what the belief behind volume being the velocity for the market, it has come from 1930s or 1940s rather, from Charles Dow. And what he believed was that high volume indicates a more accurate price, and that in turn, volume actually leads the price, right? So when a particular price is discovered by high shares being traded, high volume being traded, it is seen as a more comfortable, more sustainable equilibrium, though temporary, than a particular price being discovered by low volume, low shares. Right? So that's the general idea about why we should look at volume analysis in our securities analysis or in our technical analysis. There are certain patterns which are not dependent on volume. In fact, most of the patterns that we have seen so far are not dependent on volume, but they are often substantiated by volume. Right? For example, in a head and shoulders pattern, we see the highest volume is seen in left shoulder and the volume goes decreasing as we progress towards right. Similarly, in rectangle or triangle formation, the volume is immaterial usually, but it's often seen to be thinning out or decreasing as the time progresses until the breakout happens. And when the pullback or throwback happens, the breakout happens, the volume increases. Right? So that's how the volume will substantiate if the pullback or throwback, basically if the breakout has been substantiated by a higher volume, sufficiently higher volume, and by sufficient we have to go back to our previous discussion, previous piece of information where we had defined what is a typical volume or an average volume, right? For a particular share, let's say if 1,000 shares are traded in a particular day, then my breakout volume, my breakout transaction has to be supported by around that many shares being traded on that particular day. If that breakout is not supported by average volume, let's say the shares being traded on that particular day when the breakout has happened were barely 200, which is considerably lower volume than the average volume, then we can say that the breakout may be a false breakout and we can have the prices reverting back in the flat trading range or the channel in which the prices are being traded so far. So this is something we should consider about volumes. Now, having understood the important concepts and the important terminologies about volume, we'll move ahead with our analysis and talk about uh, different aspects of volume and volume analysis. The next chapter that we'll look at is volume as a technician's decryption device. And we'll see why we are calling it as a decryption device. And the reason being, volume helps us understand what is the mood of the market, what is the trend of the market, and what should be general expectation from the volume from the market in the short period of time. So if we look at the interpretation of price and volume movements, so let's look at this a very simple interpretation of how how a technician or technical analyst can interpret and relate prices and volume. So consider a situation when prices are rising and volume also is rising. This is the first first situation here. So in this case, what it means is the demand is rising. When the volume is rising, it basically means that there are more trades happening at a rising price, at a trending upward price, and that would also indicate that the demand for particular security, particular share or commodity is increasing. The overall interpretation or implication is that the market is bullish. But on the other hand, if prices are rising but volumes are falling, that means that the demand is decreasing. The prices are increasing, getting higher, but there are trades going lower. In other words, fewer and fewer traders and market participants are comfortable with the higher prices, and the buyers are staying away basically from this rising market. So what it means is the market is bearish. Bearish doesn't mean that the prices are decreasing, right? Prices are still rising, but it's the velocity and conviction behind this market rise, that is being decreasing, right? So if the market was an uptrend, it may slow down in pace, it may enter into a horizontal or neutral zone or a horizontal channel or a rectangle. So that is a bearish indicator, and it doesn't have to be a decreasing price always. It has to be change from either increasing to bearish, or increasing to flat, or increasing to decreasing, or from flat to decreasing, right? It could be either ways. So this is when the prices are rising. If let's say the prices are falling but the volume is increasing or volume is rising, that means again the supply is increasing. So when volumes fall, that means there are more shares available in the market. People are selling and more shares are available in the market to be traded. So what it basically means is, as the volumes are falling, there are market participants or majority of the market participants who believe that the prices could go down. And that's why they're willing to share at decreasing prices, in uh, lower and lower prices as the price fall, right? And that's why we see higher volume, so higher shares being offered, people trying to offload their positions or book profits, entering into stop loss. So what it basically means that it is a bearish market. The implication is it's a bearish market. Prices are expected to decrease further on a downtrend. But on the other hand, if prices are falling and the volume also is falling, it means that the downtrend is supposed to be arrested, expected to be arrested. So the prices are decreasing, but the steam is running out behind that drop. People or market participants are of the view that the prices have dropped enough and it's now time to start accumulating or buying rather than selling. So we see the supply is decreasing, and that's an indication of a bullish market. So the combination of price and volume can tell us whether the market is bullish or bearish. So just because prices are rising, like in this particular scenario, doesn't mean that the markets will continue rising. So if you have to enter in a position, if you're considering entering into a position, long position on an uptrend, you should consider if the volume is rising or falling. If the volume is falling, that means even though you can get into trend now, you may probably not have too much of an upside left. The market, the uptrend, the rally is running out of its steam, and the rally could reverse. The upswing could reverse anytime. But if at that time you see the volumes are increasing in general, that should tell you that there is a lot more expectation about an upswing on the upside by the market, and hence the upswing could continue for some time more. And if you enter into trade now, obviously with protecting your downside with a stop loss, that could help you get some profits, higher profits, because the upswing is expected to continue. That way you can support your positions, your trades, by volume analysis. And this is a very basic analysis. Each of the patterns we have seen has a most desirable volume trend associated with it. We have seen some of the volume trends with the rectangles and triangle patterns, head and shoulder patterns, cup and saucer patterns. But every time we look at a pattern, even in the remaining part of this course, we should ask ourselves what would be the associated volume at each stage of this trend. In shorter term patterns, which are usually one or two candlesticks or even three, four candlesticks, the volume plays even more important role. The reason being, on the shorter term, the movements are more influenced by market psychology or general emotions of the market participants than fundamentals. And that's more true in the shorter term. The prices are driven in shorter term more by the behavior of the market participants rather than the fundamentals. Hence, supporting the volume in the short term analysis, either it's bar chart or candlesticks, becomes more important. So that is the validation. Now let's look at some of the volume indicators. So far, the patterns that we had seen did not have any volume indicated or associated with them. There are multiple ways of indicating volumes. First is volume bars under the price directly. So each price or each price movement rather is associated with how many trades, how many happened, or how many shares were transacted at that particular price. That's one. Volume bars under the price. Then we have volume weighted average price, and that's not a specific measure. It's not a graph that you can chart, but it's more like a single measure. It's a unique measure, independent measure. So volume weighted average price, that is calculated as the tick price into tick volume. Now we have seen what tick volume is divided by trading volume. We've seen what tick volume and trading volume is. So this is the volume or the number of shares that have been exchanged in a particular price band or a tick price divided by the total trading volume. And when we do this for the whole trading range, let's say prices change from $15 to $20 in a given day, if we calculate what was the price exchange between $15 to $16, 16 to 17, 17 to 18, and so on, then the average price, volume weighted average price, that will act as a measure of volume indicator. Now if that particular, or let me just write it down, that would be easier to understand maybe. So prices moved on a particular day from $15 range to $20 range. So I will calculate the volume weighted price by taking the shares or the transactions that happened between each $1 increment, right? And $1 is just for our understanding. It could be 50 cents tick, it could be 25 cents tick, or even smaller, or larger depending upon the average price or the current market price of the share. So if I calculate this particular tick price into tick volume divided by trading volume number, which is weighted average price, and let's say that price is more closer to, let's say, $19 or so. What it tells me is, even though the price moved from $15 to $20, and if I have to draw bar chart like this, right? This is $15 when my stock opened, this is my $20 when my stock closed. But if my weighted average price is somewhere like here, $19, it tells me that, the price discovery, the market participants believe that the price is more accurate when it is $20 than when it was $15. So price discovery, this volume weighted average price is helping me into price discovery and getting a conviction about what price is more acceptable between this $15 to $20 range. So that is volume weighted price. Then we have volume oscillators, and volume oscillators is also a type of indicators that is charted below the price. We have net volume and price volume trend. These are again measures of volume. We don't need to get into detail at this stage. You just need to know that these indicators exist. So net volume is by definition the difference between the up volume and down volume, and so is price volume trend. So these indicators are a suggestion of how the volume has exchanged, how volume has been traded between the market on a particular period. We will look at these indicators in detail through graphs rather than understanding them as a definition. Now let's look at some of these indicators that we had discussed earlier into graphical manner. So this is an average, a typical price chart. We've seen this before many times now in our mapping and our patterns and trend lines concept so far. You know what the green bars are and what the red bars are. Green bars are when the price is moved higher, so the close has been higher than the open. Red bars are when the close has been lower than the open, so the price on the given day has decreased. Now let's see how the volume substantiates it. Now first is volume oscillator, right? So first is actually the volume bars, right? See, the volume bars which you see here, red and green, are actually the average volume or volume of that particular day, when the prices have moved. And for our ease of understanding, the volume bars are also color coded as green and red depending upon when the prices moved up or down during the day, whether the price bar was red or green. So that is again easier to understand. Now if you notice in this region, or rather if you notice in general from left to right, but the prices have moved up substantially, right? In this region the price is around 3,200 or 3,500, but during this period of time the prices have almost doubled or risen by 80%. Now so this range is around 5,700, right? 5,750, that's the current price, so which is close to 80% high. And especially in this region the prices have gone up drastically. What it tells me overall is that market is not very comfortable in this particular price range, and we see this by lower volumes in general. So the volume here have been, the bar height here has been substantially higher than the bar height here, so the price movement may not be sustainable for the longer period of time, right? If you look at the time frame here, this is 1 year time frame, right? July to June. So this movement has happened over a longer period of time, but if there is some negative news or if there is something moving against, then we can see this prices coming down drastically. Again, in this region, if you notice this region, the volume associated here has been higher, right? So which tells us that this particular movement, these small bars, have higher conviction. The market overall has higher conviction about prices increasing, and that's why we see higher market participants exchanging shares or volume, in this region. And if you notice, this price has been, no, once it has reached this price, once it has jumped in this region, it has stayed in this region, right? In fact, it has gone up further, it has not gone down. Whereas if you see in this region, the volume was not very high. So if you go back to our first chart on the table, the prices were increasing, the volume is decreasing, so which means it's a bearish indicator. And the prices have gone up, but they have also reversed and retraced the previous price levels, and it has almost reached this particular support, and over a period of time it has even reached further. It has retraced the prices so much that we see a small gap or window in case of candle charts. Here in the prices, the window is opening downwards. In this region, prices have increased, high volume, higher conviction, bullish chart, so prices have stayed up. In fact, over the upcoming, so this is around mid-November, from November till June, so more than 6 months, the prices have not reached this level. We can say that this is a pretty sustainable price zone for volume. Next type of volume indicator is we have is volume oscillators. So it is, again, as you can see, there is an average, long-term average here, or which is zero rather, which is the median line. Volume oscillator is how much volume has been traded on the upside, right, when the prices have increased, versus how much volume was traded on the downside during a particular day, right? It's always averaged around zero. So how much of volume, how many trades, how much of how many shares were exchanged on the up volume or uptick versus on downtick. So we see it being trading around zero, but a large portion is in the negative zone below zero, right? So in this zone especially, we see large volume, large portion being on the negative side. So this could be considered as a bearish indicator. So markets are on the lower side, markets are expecting a bearish movement here, and as we move here, right, this particular uptick, volume oscillator being on the upside, the positive side, so this could be a substantiation. The volume, this price movement is not a temporary, it's not a unsupported movement. It's not just a run because of some temporary news, but it's more like a sustainable price movement, and it's supported by the view of larger market participants. Then next indicator we have is price volume trend. So it is price into volume. So approximately we will see the volume, number of shares, number of trades happening into the price. So the numbers, the scale here would be unusually high, but that's not really important what the scale is. What matters is how the movement has happened. Here we see the volume has dropped, so the price volume trend is almost flat. So that's all we can decipher from here, the price into volume. So it's more of an indicator of volume weighted average prices for each particular day. Next we have net volume. So net volume is the volume difference between the uptick volume and downtick volume. So it will be obviously centered around zero, because overall it has to cancel out. So the long-term average would be around zero, but as you can see in this region, the market was uncertain. It was trading sideways, trending sideways. The volume was also net volume was also in the higher region. It's very volatile, more on the negative side below this line. Alright, so the price discovery was trying to take place. It was temporary price discovery happening, but forces were very strong on the both sides. Compared to here, the net volume has not fluctuated much. It's closer to zero, right, compared to this region. That means the volume is waning. The price is temporarily stabilized. The market forces, market participants are pulling out of the trades as of now, right? So that's all we understand from net volume trends. Next we will see how volume and open interest go hand in hand. Now remember, let's revise our definition. Open interest is not how many transactions happen in a day, right? Open interest is how many contracts are open in a particular period, as of a particular period. So that is open interest. So if we have to understand open interest better, let's take some examples to understand what is open interest, and then we'll move to interpreting open interest and relating them with volume. Let's say as a buyer, I enter into a new position, new long position, and there is a seller who's also entering into a new short position, then my open interest will increase. I have to mark it here. New buyer, new long position, and new short position, open interest will be +1, or number of contracts, how many contracts have been exchanged. But there is no new short positions. For a buyer, he is only one of the previous buyer has closed their long position, and other buyer has taken over that long position. There is no change in the short position side or the seller side. Then the number of open interest do not change. The number of contracts open in a particular market do not change. It's only the participants, the long and short sides trading hands. Right? It's only one buyer, one long market participant being replaced by other long market participants, or on the other hand, one short market participant being replaced by another short market participant. But the number of contracts which are open to be delivered in a particular time are the same. So the open interest do not change here. So that's another thing. On the other hand, if as a buyer or a long position, they close their long position, right? Their long position is closed, and the seller also closed their short position by entering into opposite trades. That means the number of open contracts have gone down at this stage, right? So in this case, my open interest will go down, right? So it's basically a proxy for how many contracts are open to be delivered in a future period of time, and that gives me what is my open interest. It is different from how many contracts are being traded at a particular time. So having this in mind, let's see how we can relate volume with open interest. So volume is how many trades happening, and open interest would mean how many of them are actually new positions rather than just old positions changing hands. So again, we have this trend. Volume, we are considering two situations, volume increasing and volume decreasing. Volume is rising, volume is falling. And if the volume is increasing and at the same time open interest are also rising, right, the first row here, then we can say that the price trend is confirmed. We are not confirming whether it's an uptrend or downtrend, but whatever trend it was in that we have calculated or what we have predicted, it is the right trend because more market participants. Higher rising open interest indicates there are more market participants entering into positions in that direction of the trend. So the price trend is confirmed. Right? On the other hand, if volume is rising but open interest are falling, so that means only the existing contracts are being traded between the buyers and sellers, but no new positions are being opened, or fewer new positions are opened, fewer open interest. That means interest in the market is waning, interest is decreasing. The trend, either uptrend or downtrend, is running out of its steam. On the other hand, is volume is falling, but open interests are rising. Then it means that interest is slowly getting generated. It's a accumulation phase. The volume is decreasing, so there are the number of trades that are happening are fewer, but these are new market participants, right? They are not old market participants exchanging contracts between each other, but they are new market participants entering with their fresh perspective. That's why we have new positions being taken. That means the market is in weak accumulation phase. The trend may be reversing, and the market participants are slowly getting profits or slowly getting positions in that direction. And if we have a situation where volume and open interest both are falling, that means price trend is contradicted. If it's an upswing, it may be turning into a downswing or a flat range, a sideways zone, or if it's a downswing, then it may be turning into an upswing or again a sideways zone. Right? So that is how volume and open interest are related, right? When they are both rising, price trend is confirmed, more market participants entering into more new positions. Whereas when they are both falling, that means fewer market participants are of the view of falling prices. The price trend is about to be confirmed or to be contradicted in this situation, right? So this is how volume and open interest are related. Now, if we add in the third variable, price and volume and open interest, then what it basically means is when the prices are rising, volume is also rising and open interests are also rising. That means there are new buyers coming in. Higher price, more buyers, more market participants, and more open positions. That means new buyer or new long positions. Falling prices, but rising volume and rising open interests. But falling prices, that means the market participants, there are increasing market participants, but they are of the bearish view. So we have new short positions being opened. Other cases being prices are rising, but volume and open interest both are falling. Then we have a short covering rally. Prices are increasing, but the number of transactions that are happening in these rising prices or an uptrend are lower, are fewer. So that basically means are either people are booking profits and exiting their position, or they are covering their shorts. And that's why we see prices being increasing. That's all. So it may be short lived. It may not be a start of a new trend. It could be a temporary movement in that direction. On the other hand, if we have the fourth situation where all the three parameters, prices, volume, and open interest are falling, that means market may be bottoming out. So prices are falling and fewer transactions are happening at this price because probably there are no sellers at this price. There are people who want to accumulate. They have reached a conclusion that the prices have reached their bottom. Fewer and fewer sellers and consequently fewer buyers. So that means, and at the same time, there are very few open positions being opened. That means the market is bottoming out and we may expect an uptrend starting soon. So this is how we will relate open interest, volume, and prices. Again, open interest is a measure or a statistic very closely aligned with volume, but it is not a volume indicator, pure definition. So if we've seen how price and volume could be interpreted together. This is true in case of shares, or rather shares where we have delivery, right? T+2 delivery. But in case of derivatives contract, futures, forwards, options contract, we have to consider open interest as an additional parameter where the transaction may have taken place today, the contract may be entered today, but the delivery of that underlying security, right, or the second leg of that transaction is going to happen in the future. So there is an open interest in that situation. So if we marry both volume analysis and open interest analysis with prices, that gives us a better indication or even a stronger analysis of the market, right? It's very difficult to actually predict when the market is going to bottom. So for my trading purpose, what can I do is, if I want to enter into Amazon stocks position, and I could be a long-term buyer, or I may not be a derivatives trader, but I want to take delivery of this stocks of Amazon, I can still look at open interest position. If I see both prices are falling and they are also supported by falling volumes and falling open interest, and these open interest are on the options of Amazon stocks, right? Amazon being one of the more liquid and more stable currencies, more stable stocks, that also has options contracts available. So if my open interest in the options of Amazon is falling along with the volume of shares being traded or option contracts being traded of Amazon, and I can see the market is bottoming out, Amazon share price is bottoming out, and at this price, if I want to enter into a long position, then I can definitely consider buying at this stage, right? So that is how I will support my open interest analysis and volume interest analysis for my stock price movement, it is quite evident for how it should be related to derivatives movement like options or futures. So that will help us in entering into positions. Mind you, it is not giving us the expected targets, price targets, and stop loss targets, but this is something we have to calculate based on other indicators. So what is the trend, what is the pattern that is being followed, that is being observed right now, and the targets either by entry price or the exit price or stop loss price, profit booking price would be derived based on those patterns which will be supporting the volume analysis.